Vertical spreads are one of the most versatile strategies in all of option trading. You could trade them in an aggressive, extremely directional manner or in a conservative, non-directional way. In this video, we're going to introduce the idea of vertical spreads and discuss the benefits and drawbacks of this strategy. A vertical spread is a limited risk, limited reward strategy. Now, this makes it an easy trade to manage compared to trades with unknown outcomes. Well, let's start our introduction to vertical spreads by reviewing just a simple long call trade. Here we have a stock trading at $50 per share. Well, suppose we bought a 45 strike call on this stock and paid $7 per share for the option. That means we have the right to buy the stock for $45 per share. Because we paid $7 per share to enter the contract, we could lose $7, we have unlimited profit, and the stock needs to be trading for at least $52 per share for us to break even at expiration. Let's add another contract to our position. Instead of just buying a call, let's also sell a call. We'll sell a call with a strike price of $50 for $4 per share. Now we have two contracts open on the same stock. One gives us the right to buy the stock for $45 and the other obligates us to sell the stock for $50. Well, let's see what this means for our profit and loss potential. We paid $7 for the option we bought. We received $4 for the option we sold. That means our net entry cost for the trade is $3 per share, and the most we could lose on this trade is $3 per share. So the first advantage of a vertical spread is that it can be much cheaper than just buying a call option. The difference in our strike prices in this trade is $5. That means the most this trade could ever be worth is $5. We know we spent $3 to get into the trade, so that leaves us with $2 in potential profit. Well, let's examine how much we could profit on this trade by dissecting the individual options. If the stock price increases to $55 per share, the call we sold would now have an intrinsic value of $5. We sold it for $4, so we would have a loss of $1 per share on that option. The option we bought is now worth $10. We only paid $7 for it, so that leaves us with a net profit of $2 per share. What if the stock stays where it is at $50? The option we sold would end up worthless. That means we would get to keep the $4 we received when we sold it. The option we bought is now worth $5. We paid $7 for it, so we lost $2 on that call. Put it together, and we still made $2. What if the stock went down just a little bit, say to $49? The option we sold ends up worthless and we keep $4. The option we bought is worth $4, and since we paid $7 for it, we lost $3 on that one. Put it together and we still have a profit of $1 per share. So the stock can go up, sideways, or even a little bit down and we'll still make money. Another advantage that a vertical spread has over a long call. Our break-even point on that trade example would be $48. In other words, if the stock was trading for $48 at expiration, our profit from the option we sold and the loss on the option we bought would perfectly offset each other. Our maximum loss comes if the stock is trading at or below the strike we bought at expiration. The most we can make on this trade is $2. The most we could lose is $3. That's a 67% return on risk. To put that in perspective, let's see how far the stock would have to move for us to make 67% if instead of doing a vertical call spread, we just bought the call. The long call option cost $7 per share and had a strike price of $45. A 67% profit on $7 would be $4.69. That means the stock would have to be trading for $56.69 for the call option to equal the return the vertical spread gives you at $50. Well, let's compare the two trades even closer. In the long call trade, the stock has to move up just for us to break even. In the vertical spread example, The stock can actually move against us a little bit and we'd still break even. Advantage, vertical spread. As far as total profit potential is concerned, the long call has theoretically unlimited profit potential, and the vertical spread has limited profit potential. Advantage, long call. Cost of entry is significantly lower for a vertical spread trade. Advantage there, vertical spread. In almost every scenario in the real world, vertical spreads are a higher probability and a higher profitability way to trade when compared with long options.